Welcome back. Well, you're still tuned into Halftime Report on CNBC-TV18. Let's discuss the Northern Capital IPO now. It opened for subscription today and it will be available to bid till the 19th of September. The total IPO size is 777 crores and the fresh issue is around 500 crores and the OFS is around 277 crores. They did raise over 200, I think 229 crores from 15 anchor investors as well. We have with us the MD and CEO of the company, Ashish Mehrotra, to talk about the IPO. Ashish, welcome to the show and welcome to our studio. Well, you're raising around 500 crores via fresh issue. Can you just give us a sense in terms of how exactly is it going to be utilized?
Sure, thank you very much. Delighted to be here and speaking to your audience. I want to take a fraction of seconds to try and explain what we do at Northern Arc. Northern Arc was established about 15 years ago with an objective to provide seamless access to the credit capital to the underserved markets. We operate in India's high growth markets, which are grossly underserved. So we bring a domain expertise across the 6 sectors where we operate, where we believe, and we operate both using a multi-channel approach. We lend both to the other lenders and also directly to the customers. That's about 50% of our balance sheet. We use that opportunity to create a sizable amount of credit solution to our lending partners. That creates a powerful ecosystem for us and builds a sticky fee income for us. We, for the last 9 years, also been running performing credit funds, which are predominantly AIF and PMS. Essentially, again, leveraging our domain expertise to deploy money in those sectors. And we are able to do all of that using our bespoke technology platform and our data science capabilities. We have about 35 million of time series of loan performance data, which is very unique to us, which comes as a function of the multi-channel approach we have. So the primary raise is essentially to augment the growth of the company. Company has been growing at about 30% plus year on year. The revenue has been growing at about 40%. The PAT growth has been phenomenal, upward of 50%. And the objective of the primary raise is to augment the growth of the company.
So if you get your business model so far, 50% of your revenues or 50% of your book is basically direct to customer loans. The other 50% is to people who will thereafter give it to people further, right? Yeah. What is the spread that you get on both of these and how is this mix likely to change going forward?
As the way to look at it, we make a fairly healthy NIM of about 830 basis points. It's a function and the NIM then get grossed up on account of the fee income between the placement and the fund management. The fund management makes about 100 to 110 basis point of fee and about the placement business makes about 25 to 30 basis point. So your gross NIM or the loaded NIM goes to 930 and you've got about 100 basis point of credit cost, 120 basis point of credit cost. And we invested a lot in our technology and branch network. So our OPEX went to about 4% and you get a gross margin of about 410 basis point, or just for tax, you make about 310 basis point of return on assets, which is, to my mind, in this business is really great. As we look at, we think the growth will happen across the sectors. Since we are deeply sector focused, we bring all the multi-channels to ensure we are able to provide the right set of credit solutions to the end customers and the counterparty whom we work with. That creates a very powerful network effects for us between the originators and the investors. The unique part of our business, given the purpose that we impacted about 100 million lives, about 10 crore people, and have deployed life to date about 1.7 trillion INR, is that a lot of multilaterals comes and participate as an India impact story. And that creates a very powerful liability profile for us.
Okay, Ashish, I just wanted to get down to the numbers. FY24, you finished your NII with almost 1,000 crores. And that's a huge jump from FY23 and even FY22. The backdated information will come up for you in terms of the financials. FY22, 370 went all the way to almost 1,000 odd crores. So it's a huge leap. What led to that? And similarly, your net interest margins as well, 8.3% in FY24 versus 6.7% in FY23. What led to this jump and what is sustainable? Is this rate sustainable for us?
I think the way to look at it, as you start leveraging your domain expertise to serve the need of the underserved high growth in a very calibrated and a responsible manner, And as you build direct-to-customer business parallelly, your NIM will expand. The second reason for expansion of NIM is also the high quality of the liability franchise we have. Our liability franchise is a function of the global multilaterals who wants to participate. Fair to say we are gateway for them in India. We also lever that opportunity to open doors to other counterparties, our originating partners who operate in a similar space. So that gives us a long-term borrowing profile. So i.e., fair to say, as the repo rate went up by about 250 basis point, our borrowing cost over the last 3 years is actually coming off. And last year, our borrowing cost only went up by 40 basis point. So gross expansion on account of the mix, coupled with the high quality liability franchise. We are AA rated just basis pure quality of our performance.
Could you break up your liability franchise? How much of it comes in from the banks? How much it comes? Where do you get your funds from, basically?
So we leverage our capital.
Right.
We get about 20% of our borrowing as of March 24 comes from DFIs, Development Financial Institution, both domestic and offshore. 65% comes from banks, largely PSU and the private sector, and balance between capital markets and other lenders. We lever that to provide the balance sheet growth. So that creates a very high quality franchise, ensures that you have positive ALM and not have negative ALM. And that creates the right set of tailwinds for us to grow our business in a responsible manner.
Okay. So just to break up your book, 40% comes from MSME lending. You have, I think, around 27% from consumer finance and MFI around 26%. We had a company which does MSME and MFI financing just a couple of days ago, and they said one of the biggest stress points for them probably in FY25 or FY26 would be asset quality stress in the MFI segment. You get 26% of your sales or your lending from there. Are you seeing any kind of chinks in the armor when it comes to MFI lending in terms of asset quality? What is the on-ground situation?
Okay, let me try and break this down slightly for you. So we have 35 million time series of loan performance data. Our knowledge comes not only from our lending, but also for the credit solution we provide to our originators and largely to our investors. If you look at my book is about 11, as of March 24, was about 11,800 crores. The equivalent amount was a placement we created with the credit solution we provided to the other originating partners. And then you have a fund management. We deployed about 10,000 crores on the fund management side. Given that you have a very evolved risk model, which is time tested over the last 15 years, we have about 30 plus risk model, which has been tested. And fair to say you've tested them in the last 10 years when we've seen both 1 in 100-year risk events and multiple 1 in 10-year risk events. That means your data quality, your understanding is very powerful. More importantly, our approach to credit is a nuance-based approach, which is function of touch and feel. Our portfolio is spread over 670 districts in India, fair to say about 80% of India's geography. About 35% of them, 200 plus districts, our independent risk team originally goes and visits and monitors what happens. Our core thesis is essentially lending to the end customer, whether we do it directly or we do through our partners. And we do 4 things, essentially how these loans are getting originated, how these loans are being underwritten, how these loans are being fulfilled, and how they are being serviced.
But
that gives you a touch and feel. So we do see that currently in some of these sectors there is a increase in indebtedness, and that is a function because of about 10 to 12% of the population have more than 4 to 5 loans. And I believe it's not a systemic piece. This is highly regulated as a sector. And I think over the next 2 quarters, this should begin to stabilize.
All right. Just a final question before we let you go, running out of time. We have data for the last 3 years. Because this is a cyclical business and you've been here for at least 3 business cycles, and with the kind of data, etc. that you have, over your history, if you could tell us what has been your highest and your lowest NIM, and what has been your worst and your best asset quality?
No, obviously, I think our asset quality, if you look at on a 10-year basis, since our data is there on a public domain, will give you the quality of asset performance we have and probably the industry-leading credit cost. Obviously, 21 we saw during the pandemic, there was a stress, but we were still profitable. So we've been profitable quarter on quarter, year after year. But on a risk-adjusted basis, we are very confident of maintaining our return on assets and growing from there on.
Okay. All right, Ashish.
Thank you.
It's a pleasure.
Same here.
Thank you very much for joining in. I'm sure we'll touch base to discuss more of the forward-looking financials once you do this. Thanks very much.
Thank you very much.
We'll take a short break, but more on the markets once we're back. Stay tuned.